Hey guys, hey, this is Al with Simple Option Strategies. All right, today I'm going to be covering intro to options and the best trades to start with. I'm going to, I put a lot of information together, so hopefully we can get through it. I'm going to try to stick to a 30-minute timetable to value your time, okay, today. So if we don't get through it all, I will certainly cover it in next week. Just to let you know, this is an intro, okay? This is an intro to options, and I'm going to be covering right from the basics. Okay, so, and I want to start out with a really, really important topic, no matter what you're trading, and it's called emotions that can kill you. Okay, and I'm sharing this because really, 90% of trading is probably psychological, and the rest is tactical. And if you can master your emotions in trading, sticking to your rules, not taking undue risk, you will make it. Okay, you will make it no matter what strategy you use. All right. So I want to cover these areas here before we get started into the main meat of the lesson here. Okay, so let's talk about it. Let's talk about greed first, and there are three emotions that I'm gonna share with you. Okay, and what they can do to you as a trader. And I'm going to go through this pretty quick. Greed basically, allows you, what it does is it creates an emotion that wants you to trade bigger so you can get faster gains. Okay, this can kill you because your decisions in taking stops and trade size, etc., is not going to be coinciding with your actual trade plan, and it can set you astray. Okay, it makes you trade more frequently rather than waiting for setups. Okay, and this is also for faster gains. Additionally, not take profits to obtain bigger gains, and so if you already have gains, in your trade, right, you'll want to hold on to it longer, so that your gains can get bigger. Okay, it's just a normal emotion that occurs, right? And then the other part of this is that it forces you to wait to take losses, hoping that losses will turn into gains. And when you see a big loss there, you say, okay, it's going to turn around and turn around and turn around. And what happens is it's just the opposite. It goes further, and then you get a larger than normal loss. Okay. The other one is fear. This one forces you to take profits, and this usually comes after, probably a big loss. Okay. It forces you to take profits early, not trading at all, possibly thinking that you're going to lose, and then not taking a loss, hoping that the market will come back, and that's kind of alongside with greed. Okay. And then the last one is regret. And this happens a lot after you take a big loss, and you become very, very negative on it, and possible multiple losses. And it causes a mindset that's very, very negative. All right. And it creates a lack of confidence. So I'm sharing all this just because it's really a big important part of trading, and I wanted to share this with you. Okay, so it's very important to keep those emotions in check. And how do you do that? By having a trade plan and sticking to it, and trading small and trading frequently. I mean, those are the ingredients that'll make you successful. All right. So let's talk about options. Options are contracts that give the bearer, all right, let's call them the trader, the right, not the obligation, to buy or sell an amount of some underlying asset as a set price or before the contract expires. All right. Just giving you the textbook definition of options here. Right. They're derivatives on an underlying asset, such as, Apple or the SPX, or, other, or futures. Right. These are derivatives. Right. So it's a leveraged asset as part of another asset, right? Such as a stock that can generate income, provide protection against declining stock, or add leverage as an asset for speculation purposes, right? That's really the textbook definition of options. All right. So let's talk about a call option first, right? And I'm gonna put it in kind of real terms, and maybe some things that you've experienced in your life to make it relevant to options on stocks and indexes. Okay, so let's say there's a development going up, and you'd like to purchase a home in as an investment. And the home is in a nice area where you like, and you want to lock in the price of the home before it goes up, right? So the developer's putting up these houses, and you want to lock in that price so that it doesn't go up up in the future, right? So the developer will actually sell you a $20,000 option to lock in a price of $400,000. Okay, and you agreed. You paid a premium of $20,000, right? So that you can buy that house when it's built in the future, let's say. And maybe this development isn't going up yet. Maybe it's going to be done in like 2 years. All right. And so you want to make sure you lock in that $400,000 price. Okay. Then after 2 years, when after the home is completed, the market value of that house is now $800,000 instead of $400,000. Well, since you purchased that option, you still pay $400,000 for the home. Okay. And the developer keeps the $20,000 premium, right? Or the contract may have a clause that allowed you to sell the option to the highest bidder. So you may not even have to buy the house. You just may, you may want to just sell it for $800,000. And so raking in, an additional $400,000 minus the $20,000 premium. So that's what happens when you exercise a call option, right? So you have the right to purchase a particular stock at a certain price in the future, and that stock goes up. You can either exercise your option, right, and get the stock, at the price that your strike price is at. And we'll talk about strike prices, and it allows you to take advantage of that profit without even owning the stock. Okay, so that's what a call option does for you, right? Okay. So let's talk about a put option, and I'm looking at the screen here to make sure that there's no questions. Okay, let me make it full size so you can see it better. All right. So let's talk about a put option. So now the put option is a little different. Okay, a put option is similar to like an insurance policy, right? Like a homeowner's insurance policy that you may have on your home. As long as the contract is in place and you're paying the premium, the home will be protected in case there's damage. All right. So, so the insurance company who is the premium seller. So they're the seller of the option and is obligated to pay you for damages that may occur while the policy contract is in place, or contract much as a cost of the damage, right? So they're obligated to pay that. And all you have to do is keep, paying the premium, right? So in the same way you purchase puts to protect your stock portfolio in case of a market crash or correction, the value of the puts go up equal to or more the amount of the portfolio damage as a result of the crash or correction, right? So that's really a scenario for a put option, right? And now we're going to go into the use of these instruments in a bit more complicated way, right? And so, if you have any questions, because I remember reading a lot of books on this when I first started, and I had to read those books over and over and over again to really get the concepts down to understand. All right. So what is this? This is an options. This is an options sheet basically showing you a particular stock, and in this case, it's Microsoft. The strike prices, and the strike prices are these prices here, right? Okay, the strike prices, and these are the value of those strike prices based on whether it's in the money or out of the money. And when it's out of the money, so let's take Apple, because I'm going to talk about Apple today. So Apple's was trading yesterday. It's closed at, I think, 124.40. Not that I'm watching it or anything. Okay, so Apple closed at 124.40 yesterday. Okay, so let's say Microsoft in this example, closed at 138 yesterday, and So anything above 138, these calls here would be in the money, okay? Because they're lower than the price of the stock. And these here are actually out of the money because these are prices higher than the call, okay? So it works the same way, but only opposite with put options, right? So let's go to the put options. Put options, same price here, right? So anything below the, let me see, question here, Victor. Calls gain as prices rise. That's correct. Puts gain as prices drop. That is very correct, Victor. That's correct. And we'll talk about that. So in the same case now here, let me move this out of the way. Okay. The out of the money puts are lower than the strike price. On in the money puts are higher. Okay. And so it just works the opposite as with puts and calls. All right. So let's move on here. Okay. And yeah, these are called option chains. All right. So now let's talk about, so I gave you the basics of options, right? And I know it's probably a lot of information if you've never heard this before. But if you need additional info, I would, you know, there's a ton of information on the internet that you can access, you know, on this. But what I want to do is I want to make this real to you. Okay. So what I did was I selected certain types of option plays that you can use today if you're a stock owner, okay, and other option type of plays where you don't need a lot of money and it's not a lot of risk, okay, in the way that it's set up. All right, it could be risky if you position it wrong, but it can be you know, it can be very, very non-risk if you set it up correctly, and you can actually leverage and make a lot more money than you can just owning stocks, right? All right, so let's talk about a covered call. A covered call, it's one of the most popular option strategies to generate income, all right? And it's done in the form of options. Number two here, to execute the covered call, an investor is already holding a long position in an asset, okay? And let's say you're holding Apple, right now, and it's $124. And then what you want to do is you want to be a call writer, which means a call seller, and you want to sell calls against that asset, right? Okay. So these are often used when a stock is not really moving in one direction or another. Okay. You don't really expect a lot of appreciable, you know, increase and in the near term, so that you can collect the premium. And we'll go over the way you collect premium. Okay. You must own at least 100 shares of the underlying stock, because options work in 100 share increments. Okay. So if you're buying Apple, right, it's going to cost you $12,400 around the price that it is right now in order to buy that stock, right? And in order to use a covered call against it. Okay. So as you do this, as you sell calls against your stock, it actually lowers your cost basis by the premium amount that you do every month, right? And I'll show you an example of this. Okay. So let's go through an example of a covered call. Let's take Apple. So I mentioned it was 124.40. Okay. So going back to the strikes, right? I'm looking at November 27 call strike price of 140. Now, is that in the money or out of the money for Apple? And I will say that it is out of the money. Okay, so it's out of the money because it's above the current market price of Apple, of the underlying. Okay, so I selected this particular strike, you know, expiration and the strike price of 140, because it's further out. It gives it time. So with expirations, the further out you go, the higher the premium. All right. And I set it above the current price so that it won't be taken out, because if the stock price goes above the 140, and we'll talk about this, you can actually lose your stock, for a profit, and keep the premium. You always keep the premium, right? So the particular premium that I found today, right, was $2.31 for the November 27 call strike at 140. All right. Okay. So let's say you own 100 shares of Apple, and at 124.40, that's a $12,400 investment, right? Now you sell one contract against that stock and you collect $241, right? Now you keep that premium, and you keep that premium even, unless the stock goes above 140. That's not true. You keep the premium even if the stock goes above 140, but there's things that you have to do, right, regarding the stock if it does go above 140. And this is the risk for covered calls. If the price of the stock goes above 140 before November 20th, you will be obligated to you will be obligated to sell, not buy. That's a mistake there. I'll correct that. Actually, let me correct that now. So there's no confusion. You're going to be obligated to, okay. You're going to be obligated to sell that stock for $140 and buy the option back at a higher price. Okay. That's one scenario. Okay. So basically the stock gets taken away from you, right? You made a profit. Obviously, if you have the stock at 124.40 and you sell it for 140, you have a nice stop. You have a nice gain. But what happens if the stock actually moved to 160, right? You would have lost that value because your call option is preventing that stock from moving higher. Okay. If you're new to this concept can be a little, hold on, let me put my notes up here and make this wider. It can be a little complicated. Okay. So hang in there with me. All right. So those are the two scenarios that you have. Now you can actually buy back that option at a higher price. All right. You can actually buy it back at a higher price and keep the stock, but it will, it's a negative return on the option. Okay. All right. So that's the risk for covered calls. However, if you have stocks that aren't moving and you want to do this, over and over again, actually it will lower the cost basis of the purchase of the stock. Okay. So now let's talk about a poor man's covered call. A little more complicated, but you'll see that the percentage gain on these is much better, and actually the risk is lower. Okay. So a poor man's covered call uses call options, to generate income, and it's much less expensive to do so. Right. So you're actually putting on, a call. You're actually buying a call, and you want to buy these deep in the money, right? Deep in the money, so that there's not a lot of premium in the option. There's something called intrinsic and extrinsic value, right? So for a call option, if it's out of the money, it's all extrinsic value. It's not intrinsic. If it's in the money, there's a lot of intrinsic, which means there's value in that option, and there's a small premium price, especially if it's deep in the money calls. Okay. All right. So now, so these are intended for not the underlying stock, but for underlying call option. And you want to do them even in leaps. Leaps are actually multiple years out. Okay. So you want to expect appreciable, price increase, over that term, but you're using call options in order to do it. All right. And you have to own at least one call contract right? And one call contract of the underlying stock in order to execute this type of trade, right? And it does lower your call cost basis. Now, what's the difference? All right. Well, the current price is 124.40. We're selling the same call option, right? November 27 call strike with a strike price of 140, and you're collecting the same premium. The difference is that instead of the stock, you're going to own a call option, right? And I selected 70, right? It's pretty deep in the money. And the premium price is 53.60. So if you add these two together, right? So you add 70 plus 53.60, you come up with a value of 123.60, right? So when I got this, when I looked at the premium this morning, I think Apple had gone down to about 121 or something like that. And so the premium on this was only like $2, compared to the value of the the price of that option. And so you could say now that there's about $50 of intrinsic value in this and about $360 of extrinsic value. Okay, very, very small premium compared to the value of that option, and that's why you want to go deep in the money. All right. Okay, no problem. This will be posted in YouTube and in Facebook as well. All right, Steve. Thanks for the question there. Okay, so you want to own one call contract of Apple at 53.60. Okay, instead of owning one share, right? So they call it a poor man's call, covered call, because you're actually spending less than half of what it would cost you to buy the shares of stock, right? Or half. So instead of investing $12,400, you're investing $5,300 to gain basically the same kind of leverage for this trade. And so half the money, same amount. Basically, you collect double the amount, on your call. Okay, so you sell one contract for $241, and so you collect that premium, right? So unless the stock goes above 140, and then that causes you to do something if it goes above 140. And so this is basically a debit spread. Okay, and I'm sure you've heard that before. This is actually a debit spread. You're buying one call option and you're selling another call option, right? And it's a debit spread because you're collecting, you're paying for that spread, but you're buying one side and collecting another, but still have to pay for that premium. Okay, so let's say the price goes above 140 before November 20th, right? You can actually be assigned the option. And so, and what brokers will do if you own the underlying, the call underneath, right, for $53, and you don't have enough money to get the assignment, they'll close out both positions, but you'll still make a profit just like you would in the share of stock. Okay. Or what you can do is buy the November option back at a higher price, right? Which is a loss on that particular, and this is the risk on this one, right? Just like the other one, you buy that back at a higher price, or you sell both deep in the money option and buy back the November 20 option, right? All those things will happen. One of those things have to happen if your stock goes above 140. If it doesn't go above 140, you keep the whole premium. And you do it again the next month, probably at a higher strike price. Okay. And so anyway, the reason they call this a poor man's, because you only have to pay basically half the premium in order to gain the same result, right? Percentage wise. Okay. And the third one I have today is a cash secured or naked put, right? And these can be risky if you're if your broker allows you to do this without having the amount of cash that you need in order to buy the stock. And so my rule is that I never put a naked put on unless I have the money to buy the stock. Okay, and that's how I work with these particular types of instruments. All right. So a naked put is an option strategy that involves selling put options. So you're selling a put option without any other purchase, right? For the purpose of gaining income or purchasing the stock at a lower price. So those are reasons that people use naked options, right? The benefits are that the underlying security goes up in price. You keep the premium, right? So you don't have to do anything. The option expires, you keep the premium, right? Naked does refer to uncovered positions, meaning that there's no underlying asset security associated with it. Okay, and that's why they call them naked. All right. So now, if the stock price falls below the put's price, the put strike price before expiration, the seller either has to buy the stock, right, at the strike price, or buy the premium back at a higher price. All right. So let's go through an example here. All right. Let's talk about Apple. Okay. Current 124.40. November 20 put strike price of 110. Right. So remember, we're doing this lower than the strike price. I mean, than the market value of the stock this time, because we're using puts. Okay. So this put is out of the money. And what you're doing is that you're selling, that's the put at 110. And so as long as the stock stays above 110, you keep that full premium. And what's the premium? The premium was $2.19. Okay. So you're collecting, when you put on this trade, $2.19. You own 0 shares of Apple. Okay. You don't need to own the shares. You just need to have enough money to buy the stock in case the trade goes against you. And trade going against you means that the price of the stock goes below 110, right? So you're selling one put contract for $2.19 and you keep the premium unless the stock goes below 110, just as I mentioned. If the price goes above 110 or stays above 110 before November 20th, hold on, let me fix this. Sorry about that. So if the price goes below 110 before November 20th, you'll be obligated to buy the stock, right, at 110, or buy the option back at a higher price. Okay. So those are the risks for this, if you do this. But I can tell you that at times when I want to buy a stock, I'll actually sell a put instead of buying it and just waiting for the stock to come down. Now the risk is that the stock's going to keep going up, and all you'll have for it is the premium, right? But a lot of people buy stocks and they'll even put puts in the money to buy stocks so that they get a full premium on those positions, right? So that's really all I had today. I'm glad it took 30 minutes exactly. Hopefully you got some value out of this. If you have any questions at all, just email me or hit me up on Facebook, and I'll respond to you and explain all I can, to help you out. All right. Okay. Thanks a lot. I appreciate your time, and we'll see you next week.